Hey, good morning once again, options traders. Well, what's an alligator spread? Well, I thought that everybody knew this term, but I was speaking with some traders the other day and I threw out this idea, said, well, if you do that, you're going to end up in an alligator spread. And they said, whoa, 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 what's an alligator spread? I've never heard of that. Well, I thought that everybody had heard of it, but evidently not. So I thought maybe some of you might like to understand what is an alligator spread. So let's go find out more. Before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So the alligator spread, what's this all about? Well, it's not an actual trading strategy. It's not a vertical spread or a calendar spread. It's meant to be more of a tongue-in-cheek expression, and it describes a spread where you can't make any money or very little. Remember, all spreads have some type of a limited gain. And so if you're in a spread where you just can't make any money at all, or at least very little, that's what we call an alligator spread. In other words, you're up to your eyeballs in alligators and you'll never get out alive. So an alligator spread isn't one that you look up on your broker's platform and say, I want to go place an alligator spread. In fact, you want to run from it. You want to do the opposite. You don't want to enter an alligator spread, and you don't want to end up holding one. Because what it shows is that you are now holding all risk, or at least mostly risk. There's really no reward. There's no benefit to you. Now, in previous videos, I've referred to this as dangers. And that's another way to understand what an alligator spread is. So you're just in a situation where there's no sense in holding it. It just represents all risk and very little reward. So as an extreme, what we might call a perfect textbook alligator spread, let's say that you buy the 100-105 vertical spread for $5. Well, most of you know that the most this spread could ever be worth is 5. So if you pay 5 for it, you can't make a single penny from this, but you could lose 5. So I like to start off with this one because this would be an absolute perfect example of an alligator spread. So here we see our vertical spread. There's our bends at 100 and 105. And our max loss here would be 5, the amount that you paid. But look at this. We have none of our risk graph sitting above 0. The entire thing's underwater. The very best you can do is to have the stock close at 105 or higher, in which case you make nothing. But you did spend a commission to get in and probably one to get out. It's going to be a net loser. Now, a reason I like to bring this up is this was a fairly obvious example, but if you are, let's say, doing some hedges, rolls, morphs, you might end up stepping into one of these without knowing it. Now, back in the day when all of the trades were done through a broker was not allowed to accept a trade like this from a client. It's what's called no economic benefit, and that would usually lead to a forced, what's called busting of the trade. But nowadays, when everything's electronic and you're self-directed, they're not going to be so forgiving if you happen to step into one of these. So just because this might seem very obvious now, it's easy to step into them if you're doing hedges, rolls, and morphs. So within this whole idea of alligator spreads, there are really two basic types. You could either enter into an alligator spread, which I just showed, or you may end up holding one in the future. Again, it might be that the spread has now finally maxed out or gotten very close. Well, that's an alligator spread. So let's take a look at both of these. Let's say that you buy the 100-105 vertical spread. You didn't pay 5, but you paid 4.75 or something higher. Well, now your max gain is 25 cents. And with a commission in and a commission out, what's the point? This would be your risk graph that we just saw. We've got a maximum loss of 4.75. We have a whopping 25-cent gain up here. Now, the reason that a lot of traders like to do this is, yeah, of course, to get this risk-reward ratio, the stock's got to be way up here. So if this is a debit spread, it's very deep in the money, high probability for success. That's why the traders are bidding it up to 4.75. Or if it's a credit spread with puts, then we could say that they have sold it down to a level of 25 cents because, again, it looks like free money and people are just pounding in the sell orders because the stock is way up here. But you got to be careful of this. right? You have to say, what's the point of having such a small handful of peanuts here for a reward when if it goes against you, it's going to go against you hard? All right, so this would be another one that most people would consider an alligator spread. Now, again, remember, it doesn't mean that you had to enter it. You could end up in an alligator spread over time. So, for example, let's say maybe you did the 100, 105 vertical and you paid a buck 80 for it. And you're going, okay, I've got 320 of a maximum gain. Remember, it's a 5-point spread. That's the difference in strikes. So the maximum the spread could ever be worth is 5. If you paid a buck 80, that leaves 320 in your pocket. So yeah, this doesn't seem like such a bad risk-reward ratio. But remember, this is your expiration curve. The stock is out here somewhere. That's why it's relatively cheap. So the current curve might look like this. And let's say a week later, then it might move to here. A week later, it moves to here. It's a very slow climb. And every day that passes, you're going to start seeing the current curve moving closer to the black. But let's say that the stock is up here, maybe around 106, and you're sitting just in this little sliver right there. Well, now you're holding an alligator spread. You shouldn't say, well, I paid a buck 80 for it. This isn't an alligator spread. Well, true. At the moment you bought it, it wasn't. And over time, it wasn't. But today it is. And that's because right now, there's not much left that you can make from it. So there's an example where you could end up with an alligator spread over time. So really, any spread is susceptible to being an alligator spread. Let's look at a calendar spread. Maybe you buy the 180-day option and sell a 30-day option. Those are days to expiration. And the net debit, let's say, is 465. Max gain might be 412. This is what the risk graph would look like at expiration. Expiration of the short-term option would be in black. The current curve is in blue. Over time, let's say a week later, it goes to maybe this position. Remember, over here in the wings, they're sinking down towards the black. In the center, they are rising up towards the black. So over time, we're seeing the center part get closer and closer to this peak. But there's a very big risk here. Yes, there's no doubt that in a few days you might be way up here. But look at that curvature. That's your gamma in there. This is just going off the rails. And if that stock makes even a slight move up or down, you're going to end up way back down here, possibly into losses. So one of the tricky things about calendar spreads, really all spreads for that matter, but especially calendars, you might take several weeks to work your profits up to these levels, and in a matter of a couple of days, watch it all go out on a fairly small stock move. That's because it's an alligator spread. So as this point, this current curve right here, starts moving closer to this expiration point, if you're letting it get too close, there you go. There's your gators. That is now an alligator spread, even though it wasn't when you first placed it. We could end up with the same thing with a covered call. Now, remember, a covered call is technically a spread. A spread is being long an asset and short one. Here you're long stock and short a call, but it's still long an asset and short an asset. Covered call is a spread. So we have limited gains. So let's say that you are long shares and you short a call. That would be your covered call. And traders often enter with good ratios, but they hold on too long. So they end up with an alligator spread. So here's the risk graph, maybe when you first placed it. Black curve is expiration, and the blue curve is the current curve. But let's say a week goes by, some more time goes by, moves up again, moves up some more. It keeps marching closer and closer to this black curve at expiration. But let's say the stock might be up here, maybe 106 or 107. And how much extra profit can we make in here? It's that little tiny wedge right there. So even though the risk-reward graph looked good when you entered it, yeah, you might be able to make, looks like $7 or $8 here. Right now, the additional or the incremental profit is pennies. So if the stock is up here, that's an alligator spread. You've got to watch out for those. So always remember, avoiding losses isn't easy, but that's really the name of trading. It's about risk management. But avoiding alligators is be sure you're not entering or holding an alligator spread. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.